Joel Santana, Dipset / Taliban. I see you, Joel, spitting on them blades. Talk to these niggas. See money, Shay LaFon, Dipset. Stop Dipset, yo. Hey, yo, listen to this gangsta. Feel this music, man. Get into this gangsta. Cause this ain't just for gangsters. Where my niggas at? Where my bitches at? Get into this gangsta. This ain't just for gangsters. Now let's get down to business. I've been going for a minute, but I'm back now. Down for business, yeah. I found this small town I had to visit. Had a bunch of hungry workers who was down to get it. So I got up and left. This in town with Britics, nickels, dimes, quarters, almost half of Britics. Know the rules of getting mad if they ask to get it. Plus I was giving it to them like I had permission. Now I'm back focused on rap. Anybody got a problem, holla back. Swallow that. And I know what the people want. I know around this ain't got shit. I've been plotting. I'm the realest thing popping since Osada been lying. So pay homage. Ladies salute me. Gentlemen salute me. Listen to this gangsta. This music, man. Get into this gangsta. This is for gangsters. Where my niggas at? Yeah. Where my bitches at? Get into this gangsta. This is just for gangsters. Hey, yo, listen to this gangsta. Feel this music, man. Get into this gangsta. This is just for gangsters. Where my niggas at? Where my bitches at? Get into this gangsta. Cause this is just for gangsters. I got you niggas exhausted. You gotta be nauseous how I pull up. Stopping me flossing. Chrome wheels spinning out of proportion. Twin spikes on the back, letting out the exhaustion. Whoa, can't love me, but I'm no idol. I hold rifles, dog, my spit game is so vital. I'm with the game, been missing like both Michaels. Jackson and Jordan from tracking the ball, and I'm back. I'm a heavy pimper, 24/7 pimper. With your girl, don't get her, bet I pimper. And I ain't mad that the towers fell. I'm mad the cool price went up and the track won't sell. Mad I gotta grind harder, hit the block harder. Get some new workers, buy some new product. Get my clientele back, shit I might as well back. Burn the town down one more time, what the hell's fat? For my niggas who can't get it, I'm sitting.
How about bundling your home and auto insurance with NJM?
I'd save a ton of money, but it would really just change songs mid. Damn. Change songs, bro. That's what happens when you use your backup account. Man. New day. Oh, tell them that I sent you. November. Oh, I have it sent up. Have it sent up. Have it sent up. Town I'm liking. In the town I like it. With the pound and light it. Like it's my block now, I'm right here. And he understood me right clear. Then that thing bang out and bring out the side of his right ear. Woo. Business. Private vision. Sitting. Living. Listening to gangster music. Hey. Watch the cat. Fucking man. Watch the cat. Fucking man. I'm in the city where the skinny niggas die. Nope. I'm in the city where the skinny niggas rob. Pop. Yeah. Big pop to pop. Yeah. With the shot. Yeah. Yeah. Okay, okay, okay. No way. Camacho. The best.
I stood alone watching the war and its own hand on my head.
Listening to gangster music. Hey.
I stood at home here with its own thinking and camera. Watching how the gangsters do it.
Hey. I really mean it. I really mean it.
Killers back and forth. They actually haunt us. Caddy more trucks and daddy more bucks. Ain't you off in mine? Take off your panties. Cease off and stand. Yeah, let's get lost. I got lost in Boston, Austin, of course, Miami. Sip pina colada. My mama's lean on the Prada. I rock more Phoenix. Roll the glory scene if you see it. The game of music is pain and music.
So,
This year,
I really mean it.
I can name the beat game to do it. Took the brains to do it. Y'all just kidding. See what I just did? Sing a couple bars off, let just live. Yeah, that's powerful music, man.
Yeah. Yo, 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 yo. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall. Now return today to Whap and Tap on your head with a midday monetary Monday. So we're continuing. This is part 3 of Wealth Beyond Wall Street. A way to supercharge and finance yourself. So yesterday we got cut off midstream because I had some good cooking from my wife, and I had to eat dinner. So we're going to pick up where we left off in the middle of chapter 9. But before I go in, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So as we proceed to give you what you need, Wealth Beyond Wall Street, middle of chapter 9. You want to catch the before? You can catch the yesterday's. So the IRS has set up guidelines that dictate how much cash value you can put into a policy compared to the insurance amount. If you exceed their limits, meaning you put in too much cash, it could leave negative tax implications, essentially ruining one of the major benefits for getting an IUL. As an insurance professional, I prefer to structure the policy so you stay under the MEC limit in order to enjoy maximum tax advantages. Yeah, Jason replies, I can see why we want to work with someone who's been trained to do this properly. I'd hate to lose out on tax savings just because of an untrained agent. If this is so great, Susan chimes in, why haven't I heard anything about it? Is it because it's new? Now I'm going to stop right there. If y'all remember, he said a lot of agents don't do this because it generally cuts what we make off of the policy in half. And why would you want to cut how much money you make in half? And if anybody watching right now is familiar with JT the Pocket Watcher, I actually went on his show and explained to him the concept of infinite banking is a very expensive concept. Usually, the starting point is on average $1,000 a month in annual premium, and then properly set up, you can then take advantage of the concepts that are being spoken of in this book. However, again, like mentioned in this book, you have to work with an agent who's trained to do these things and understands the concepts. And that is few and far between. Luckily for you guys, I'm one of the ones who actually understands that. And the agents on my team are being trained by me, so they're going to understand. Um, but I explained on JT's show. Um, he was like, "Well, why?" I explained to him, "Yeah, another reason that whole life agents don't like index universal life for infinite banking is because it lowers your commission." He said, "Well, why in the world would you want to lower your commission?" Well, I explained to him that once you teach someone and show someone, when you show someone the light, they walk through the door, right? So, um, i- they end up funding the policy more robustly. So it ends up being a win-win for both parties. At any rate, what's going on, Broke Genius? What's going on, Omanike? What's going on, Queena and Malika? So, if so, this is great, Susan chimes in. Why haven't I heard anything about it? Is it because it's new? Absolutely not, Michael answers. In fact, Americans have been using permanent life insurance policies for over 100 years. Large companies, business people, and average citizens protect their capital by buying cash value life insurance policies on their employees and then using these cash value life insurance policies as strong foundations. One reason why you might not have heard about it is that gurus, bankers, and Wall Street have no interest in promoting these policies because they often want you to invest in the market. Okay, Jason nods. So, how do we get started? So, the bottom line is this, Michael explains. You can start by funding an IUL, a special type of cash value insurance life policy. Excuse me, a special type of cash value life insurance policy. Then, instead of borrowing from a bank, you borrow from your policy. You simply use a different way to pay for things. A method that lets you recoup the cost of large purchases instead of letting that money go into a lender's pocket. And all the while, you're growing a tidy nest egg, one you can predict, and even better, one you can count on. JPM, what's going on? How's your spirit? So, that sounds good, Susan agrees, but I'm not sure I understand. Why not just put my money in an interest bearing savings account and then use that money to buy the things I want? Wouldn't I actually come out ahead in the long run? First, Michael replies, how much does your money grow in a bank account while you aren't using it for something else? 1.5 to 2% if you're lucky? Shit, you so he's talking high balances because eh, anyway, if you invest in a bond or a CD, the percentage of growth will be a little higher. Now consider this. With an IUL, not only can your money grow between a floor of zero and a cap, but if you structure and fund it right, as an insurance professional, I know how to do it right. You could also receive growth when the market goes up without risking your money in the market. What's going on, Kay? But here's the part of the answer that's really convincing. Michael continues. Let's say you deposit your money in a bank account and then withdraw the $200,000 we talked about to pay cash for a car. Does the bank continue to pay you interest on the money you withdrew? Of course not. But guess what? Your IUL policy does. That's the amazing thing about an IUL. People really think it is too good to be true, yet it is true. And it can be a great financial tool for those who take advantage of it. I've got to admit, I'm pretty stunned by all this, Jason says. I just went through a pretty big hassle with the 401k deal. Are there rules here? I mean, what kind of things can I borrow money for? You can borrow from your account for anything you want, Michael answers. You can run many of your large purchases through it: cars, vacations, business expenses, home improvement, and even real estate purchases. It's your money, and no one's going to tell you what you can do with it. So, how many times, y'all, have I said you can get a mortgage or a house through your life insurance? Get your MAP, your mortgage acceleration program. I've been talking about that since 2012, and I've only been up here a couple of years. I should write a book because social media is a great way to get your message out there, I guess. Ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. That is always share, share, share. Lastly, to continue to contribute to channel growth, or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So, as we proceed to give you what you need, it's your money and no one's going to tell you what to do with it. So, it's like our own source of financing, Susan says, but we set the terms and have more control over it. Exactly, says Michael. In the end, what your IUL policy really can give you is a solid foundation, a foundation for your overall financial plan that you can count on without risking your principal or worrying about what the market is doing or getting access to your money if something comes up. It's a predictable and protected way to put away your money. Following this approach could ultimately create millions of dollars in wealth for you and your family, while at the same time allowing you to reduce the amount of interest you are paying to banks, credit cards, or other financial institutions. Sheet in a million, what's going on? And that just remind me, I don't have the background music on. Hold on. Should I put some background music on? I can't turn this page. The relief on Jason's face is obvious. After what we've been through, this would really allow me to sleep well at night, he says. Absolutely, Michael responds. You don't even have to wait until you retire. You get to enjoy the benefits now. For example, we can structure and fund the IUL, and if you want to take a family vacation next year, just get started now. When the time comes, you pull out a couple of $1,000 and go. Then pay the loan back, and you recoup the cost of that vacation, and it's there for you when you need it next time. So we can use it for the kitchen remodel we're thinking of doing too, huh? Says Susan. Absolutely, Michael replies. Home improvement, college, cars, even invest in a business or real estate, whatever you want. Then, when you're ready to retire, you can take loans without having to pay taxes on that money as long as it's structured and funded properly. I'm pretty much sold, Jason says, and Susan nods. But you can imagine we don't have a lot of cash on hand right now. How much do we have to put away to get started? The cost to you is only in the amount you want to pay in premiums, Michael says. There are several different ways to get started. Some folks redirect savings from current income. Some move part of their savings sitting in the bank over. In fact, there are many different ways to find money to fund an IUL. Remember, you will want to structure the IUL so your premium payments are used to pay the cost of insurance, and anything above the cost of insurance is allocated to an index account that receives interest credits. But we have to make monthly premium payments, right? Susan says. Now, this is true partially. Most people are going to have to make monthly premium payments because most people don't have 15, 20, $30,000 just sitting in an account to be able to fund a policy annually, right? If you do, there's options there where you can just directly put the money into the account annually. But if it took you a substantial amount of time to build that money up, then, if it took more than a year, obviously, to build that money up, then you don't want to just, set yourself up for an annual payment that's not feasible. But you can always start it with say, you know, $10,000, $15,000, and then you can switch to a monthly premium payment. Or you can fund things once every 3 months, once every 6 months, or you can fund things one time. Now, funding things, this isn't me reading from the book, this is me telling y'all what I happen to know. So you can also fund things one time. Another cool thing is, and they'll probably get into that in this book as well, is something called premium financing, where ironically enough, you have to qualify for it, but you can actually take out a loan to pay for your insurance policy. Why would you do that? Because the loan for the insurance policy is something that you don't have on hand, which is the cash on hand. So again, like I said, in that single premium payment where you're going to pay one time, let's say you pay $250,000 into the premium one time, but it buys you a $10 million death benefit properly structured to do the principles that we're saying in this book. But obviously, you don't have $250,000 right now. It's likely that you can go ahead and start paying it back. And then over time, you've got the cash in your policy to literally liquidate that loan. And then instead of paying the loan back and paying interest to the institution that paid you the loan, you start paying yourself back. But it's kind of a way to supercharge or fast work your IUL. Like I said, they'll probably talk about that principle in this book too, which is cool. And I see why they're even saying, like, it's a good selling point, right? If somebody who maybe doesn't know how to do this just reads the book, because then people will be like, oh, cool, maybe you know how to do it now. But that's not exactly the case. You have to know how to actually do it to make it work, right? It's hard to explain. Um, but everyone has their certain niche, right? You know, the janitor knows how to get, you know, gunk off of the tables, et cetera, et cetera. Anyway, but we have to make monthly premium payments, right? Asked Susan. Not necessarily, says Michael. It's very, oh, and then the other cool thing about IULs, what's going on, Mr. Mister? The other cool thing about IULs before I go is the flexibility of premium payments, right? So you can fund it, right? You start the contract, there's minimums and maximums. So the minimums are, if you start the contract and you say, let's say you pay $100 a month, right? And then you get you play a scratch off and you win, you know, some money. So this month you want to put more money into your IUL because it accelerate the cash value growth even that much more, because anything paid over the cost of insurance goes to your cash value, as they said here in this book, right? So anything you get a month where you want to pay more into it, you can do so. So this is another reason why IUL beats traditional whole life for infinite banking. This again isn't the book, this is me talking. But I want to talk shit to people like Dr. Jake Jacobs and Chris Kirkpatrick of Life 180. If you guys watch Pocket Watching with JT, he brought Dr. Jake Jacobs up there, and he's a proponent of private banking and infinite banking. But they like to use traditional whole life as opposed to index universal life. And the reason I say index universal life is better is because the flexibility and premium, right? With traditional whole life, when you set up, you can set up infinite banking with traditional whole life as well, but you don't get the flexibility and premium. So if you are set up to pay $100 a month, that's all you can pay in. Or like they like to do, they offer something called PUA, which is paid up additions, meaning that you can actually schedule paying in more. But that has to be something that's determined when you start the policy from the beginning, and then they predetermine when you're going to pay in the PUAs, right? You can't do it on a whim. Whereas with an IUL, you can say, hey, I hit the lotto this month. I'm going to pay $500 into the premium, even though I know I only needed to pay $100 into the premium. And again, because of the way that the life insurance is set up, anything more over the cost of insurance that you pay into the policy goes into your cash value. So actually, that's a good question, Mister Mister. I tell people that the minimum is whatever we go in the contract, because you don't want to look at if you can't reach that, but there are actually minimums. The dangerous thing about minimums, and this is where your quasi, your fake ass financial gurus um will dish on IULs or even permanent life insurance. They illustrate it to do what's called fall apart, which means that you're underfunding the policy. Basically, what these guys are going to explain to you right now, he's just explaining IULs. I'm sure in this they're going to talk about overfunding IULs, which is what I talk about, right? So again, because he's just talking about the infinite banking concept on a premium where you're just putting the money into the policy. He hasn't even gotten into overfunding the policy. But if you don't have enough that to go into the policy, what happens is you're doing something called underfunding. And when you underfund the policy, it's going to what's called fall apart. So basically, what a lot of insurance agents will do is they'll sell it to you as a cheaper whole life, or they'll tell you some bullshit like Primerica, term to 95, which is just an underfunded permanent policy. So it's a policy that the monthly premiums are a few dollars less. However, as it goes, the cash value is completely erased, and it buys you what's called either you stop paying and it buys you what's called extended term insurance, meaning the cash value gets eaten by the premiums monthly and you have no cash value, and then when that runs out your policy is canceled or lapsed, like a term, extended term, or term to 95, like a lot of term life people like to tell you, which is a permanent policy that's underfunded, so there's not enough money to keep up with the cost of insurance and to give you cash value. So because it's a more expensive policy, the cost of insurance is out the you don't even reach the cost of insurance when you underfund the premium. So if you're putting in $1,000 a month, Mister, the minimum that you can put in is $1,000 a month. That's why when you're talking to your financial professional, you want to go over those things. What's in your budget? If $1,000 a month is your max, maybe you put the premium down a little bit, or maybe you make some adjustments there, right? So you have the wiggle room. The idea is not to underfund it. The idea is to overfund it. So the idea is not to be stretched. The idea is to, complement it. What's going on, OG Patrice? So hold on, y'all. I gotta go get me some water. It's bubbling, baby, baby. Okay. Ow. I'm getting old. So, uh, but we have to make monthly premium payments, right? Asked Susan. Not necessarily, says Michael. It's very flexible. You could pay all up front, pay yearly, or even set up what I call an automatic wealth building machine. This would automatically transfer money from your bank account and pay your premiums each month without you worrying about it. But I imagine the real question, I like the way he said that. But I imagine the real question you were trying to ask is how you're going to come up with the extra money. That's something specific I want to talk over with you. There are quite a few places I can help you find money to fund your policy. I'm confident that you can easily and probably painlessly divert money from other sources to build your cash value without changing your lifestyle. Let's start with the most obvious. How much money do you get back on your tax returns each year? Bada bum boom, which is why I went and got my PTA, my preparer's tax identification number, to not do taxes, but to catch up with folks when they were doing because I was in the hood. I was in East New York doing it, and I was like, "Yo, this is a great idea. Let me get my pizza and work out of this tax office. And when the folks come in and they get their $4 and $5 and $10,000 tax returns, show them how to create wealth, and they can fund it every year because they're gonna get their $4 and $5 and $10,000 tax returns. And instead of buying a fucking Lexus with their tax return like I'm gonna do this year, they're gonna go ahead and um." Fund their life insurance policy. And we got Mr. Blue Collar. What's going on, bro? And we've got I'm listening. What's going on? Said so. For example, we should agree to a $200 premium with the intention of paying 1,000 rather than paying 1,000. Again, that's actually a variable question there, Mr. Mister. Because it depends on what you're structuring the policy to do. Because structuring a policy at a $200 premium is going to have a different result and a different strategy than structuring a policy at $1,000 a month. Because of variables like things like age, uh, health conditions, such and such that have effect on what becomes issued, but other factors uh, that are taken into account, right? You can't just look at it as I'm paying $1,000, right? Because yes, that's part of the reason of getting the policy, but life insurance holds a multitude of things. So I'll give you an example. I have a client right now who has a house. Um, and the mortgage is 800 some odd $1,000 currently. So we put a $850,000 death benefit on him. However, he's paying $20,000 a year into the policy. Now, he's also in his 40s. So in your 40s, $20,000 a year will get you way more than an $850,000 death benefit. But the way that we're structuring the policy is that we're supercharging the cash value accumulation. So we're buying less death benefit for more premium. But we're also making sure to protect his assets because God forbid he passes, he doesn't want anything to happen where his family cannot keep this $1 million home. So that's why that's a variable question. You can't just go based on I want to spend $50 a month. What's that gonna get me? Well, there's a multitude of variables in that, right? This again is why the book is saying you have to work with a professional who knows what they're doing versus a professional who just read the book and can tell you, see, this is what I'm telling you. I read the book. I know. Right? Hi Wanda, how you doing? Yeah, don't spend your tax return on a truck full of cigarettes. Yeah, I got you, man. That was a good one. I'm not even gonna hold you. Oh man. So, where was I? So, but we have to make monthly premium payments, right? Asked Susan. Not necessarily, says Michael. It's very flexible. You could pay it all up front, pay yearly, or even set up what I call an automatic wealth building machine. This would automatically transfer money from your bank account and pay your premiums each month without you worrying about it. But I imagine the real question you were asking. Oh yeah, so we already got this. So let's start with the most obvious. How much money do you get back on your tax return each year? Jason says about 4,000 to 5,000. Okay, so that's about an extra $400 every month that you're sending to the IRS for no reason. Is there a reason you like to let Uncle Sam use your money for 12 months without paying you a dime of interest on it? Well, when you put it like that, no, I guess it's not a good idea, is it? I just don't want to have to pay extra when the tax time comes around. Jason finishes. I understand. It's easy to set your deductions so that you still get a small refund while allowing most of your money to stay with you to use throughout the year. If you add up the 4,000 to 5,000 for the next 15 to 20 years of your working life, that can be an extra $100,000 you could add to your cash value. Well, Susan breaks in. We should do that immediately. We can build a policy that works for you. One client bought a cash value excuse me. One client bought cash value policies on each of his boys when they were very young. At the time, his intention was to accumulate some cash, but to also provide them with death benefit coverage when they became adults and responsible for their individual families. As it turns out, one is now married with one daughter. He has cash value that can be used for his daughter's college expenses, braces, family vacations, or new cars. The young son, who is still single, has cash value to continue his college degree, replace his vehicle when the time comes, or make a down payment on a home. Eddie Murphy was never a bald, handsome black man. So we could set these up for our kids as well, Susan asks. Yes. In fact, once you get your own IU, hold on, time out. Wait. Hey, Sheed, can I use you as an example? Did we not do this for your children in essence? I have real life testimony to this, y'all. I didn't mean to put you on blast, bro. But shoot, he actually goes out there and says it himself. He says it in a lot of spaces. I I appreciate it, but there's a reason why people are touting you come see your brother. Um, so yes, in fact, once you get your own IUL in place, many people end up with multiple policies in the family. Kids can use them for a college funding option or to pay for their first car or house, Michael replies. So once we get started, can we start using the money right away or do we have to wait? Jason asks. And this, I get that question all the time as well. And again, that's a variable because it depends. Very similar to the question that Mr. asked about the difference in paying $200 a month premium versus $1,000 a month premium. Prime example, if it's a policy on your kid and you pay $1,000 a month in the premium, you're definitely likely going to be able to access that money by the next year. However, if it's Mr. and he's 45 years old, he's definitely not going to be able to use the money next year, even funding it at $1,000 a month. Now, also, when getting life insurance on children, there's certain things that are up in the air. Number one, you have to the owner or the parent has to have double what the child is getting. I know they tell you about that Gerber gripe, life grow up, and all those other bullshit policies, but I'm talking about especially when you're building real wealth or you're going with those big boy companies. Now that particular rule is a rule that is with particular states. It is a New York thing, so that might just be like why what's the name? Just like Regulation 187 is a New York only law. But as New York goes, the rest of the country goes, especially since New York is the financial capital of the country, right? And my resident license is New York. I cut my teeth on Wall Street, so it is what it is. At any rate, ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the link is in the description of this video. Listen, no policy is BS. Let me retract that statement. No policy is BS because the best life insurance policy to have is the one that's enforced at the time it's needed. I don't care. I don't give a fuck what carrier it's with. I had to use that, as Adrian Nash would say, sentence enhancement, right? So I don't care what. Hold on, y'all. I got a phone call. This Mom Dukes. All right. So where was I? So yeah, sentence enhancements. I don't give a fuck who the company is that you have your life insurance with. The important thing about life insurance, the number one thing about life insurance is passing money down to the next generation. So I don't care who you have it with. The best policy to have is one that's in force at the time that you need it. I don't care if that's term or whole life or universal or index universal, because the most important aspect of life insurance is the death benefit. This is why investment advisors tell you keep your insurance and your investments. And that's why I'm saying that too. However, with insurance, you want to make sure to take advantage of some of the things that are available with it, um, because of reasons, right? So, what's this next question? I will want to use my IUL as saving growth as interest, and I will be able to leave it to my kids, future kids. Well, again, so then the IUL may not be the particular product that would be best fit for you in that situation, right? Just because I'm a proponent of IULs, I'm a financial professional. So just because I like this product a lot doesn't mean that it's the best product that fits your situation, which is why you have to have a consult with me. Just because I'm like, hey, IULs are great. I think everybody should take advantage of an IUL. However, when we're looking at your entire financial picture, the IUL is not always the best option for every person at that particular moment in time. Sometimes a term policy may be the best thing for you. Sometimes a traditional whole life policy may be the best thing for you. Sometimes a blend of a whole life policy with what they call level term insurance can be the best thing for you. Thank you, Wanda. So yeah, y'all, and I'm gonna have to stop and come back because my wife last night made some banging baked macaroni and cheese, but she made an extra pan because she knows my mother likes her macaroni and cheese, and so my mother just got off work, so she called me and said, "I'm gonna be over there in a couple minutes to come pick up my macaroni." So I'm gonna stop and chit chat with my mother for a few minutes, and then come back and pick up where I left off with y'all. Um, but no, my mother, that ain't gonna be but 5 minutes. She might just come pick up the macaroni and leave. So I might just have to leave y'all on live for 5 minutes, right? Um, But so yeah, Mister, again, number one, the best policy to have point blank period end all be all is a life insurance policy. Term, permanent, whole, whatever. With whoever. Well, not with whoever. Make sure it's a financially solvent company. But even the companies that I talk down to about, that's the operative thing of life insurance. Just like the best thing about a house is living in it. Right? So, you know, that's the best aspect of a house, living in. And actually, being able to uh, enjoy the, what is it, the use of the asset, right? And that's the cool thing about IULs. An IUL is definitely meant to be used while you're alive. Like they stated in the book, you have many things that you can use your life insurance for. If you Google, criminals were using life insurance as money laundering tactic. So there's just so many wild and crazy kid different things you can do that again people aren't taught about through life insurance, right? Um, I am gonna get back to the book. Hold on, I gotta see which one is which. Okay, that's ours. So this must be hers. I'm going and getting a. That's funny. He said, I wonder if I could add a rider on my life insurance policy that gives me a living benefit that includes baked macaroni and cheese on my last meal. I mean, that'd be some, unless you try and go to prison, but I know you ain't trying to do that. So, but yeah, definitely, you gonna want some of this of my wife's baked mac and cheese. It's what do the kids say? Slapping. As I'm sitting here getting dressed, I might just bring y'all with me as I go bring my mama the macaroni and cheese, right? It's not a bad idea, right? We live, right? Sometimes you got to have some variance to it, right? We can break it down in a couple of, Francis got a couple of different ways. Um, and I'll put this here on the table, and then I will go grab my book, and I will get back to it with y'all. Actually, let me throw on my thermal while I'm at it. So that, oh, you know what, Wanda? I did promise that I would try and do a plank for at least 30 seconds while I'm reading to y'all. So I guess I'll do that right now, right? So actually, while I'm at it, I'll start off with 10 quick push-ups, and then we'll go from there. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Okay, quick 20. Ah, okay, we all mean. Listen, my wife made enough for everybody. Let's go. You should move those funds over with me. I'm gonna tell you, like I told the agents that yeah, OG Patrice, you're in my age range, so you're gonna remember this joke. I'm gonna tell you, like I tell all my clients, come to death row. No, um, no, definitely click the link in the bio, and we'll have a discussion because don't be completely afraid of the banking industry itself, but you want to become your own banking industry. So schedule a consult, and I can give you kind of a more direct answer. But one of the things is um, reformatting your life insurance, not just increasing it, because increasing your life insurance is a great way to get the insurance agent paid, and it's a great way to have a bigger death benefit. But as you'll hear in this book, again, you have to make sure that the policy is properly structured. And part of properly structuring it, if you're looking at the banking aspect or the wealth building aspect, is not just the aspect of passing down generational wealth, but the aspect of being able to utilize the policy whilst you're alive. So that does include, again, as I don't know if you were here earlier, but I mentioned an example of a client. So he has a policy that is an $850,000 death benefit. However, he's paying $20,000 a year into the policy. So at his age, which he's in his early 40s, a healthy male paying $20,000 a year will get you way more of a death benefit than $850,000. However, the way that we've structured the policy in his financial plan, because you don't just buy the life insurance policy and set it up a bunch just to overfund it. It has to be part of your complete financial plan. Right. So when we're looking at it, it is there's you have to look at more than one thing. There's a bunch of moving parts, right? It's not just, hey, life insurance, get a bunch of money out of life insurance, because if you dump $1,000 a month into it, but that $1,000 a month happens to be half of your rent. Well, now you can't afford to live, even though you're setting up your future bank, right? Or so, there's a lot of things that you have to take into account. Um, if that kind of answers your question. But yeah, you guys will see from the book again when you're overfunding it. So uh, there's a lot of different moving parts to it, and you'll have to. I'm trying to look for the words. So yeah, just don't be completely afraid of the bank, but start becoming your own bank is what I would recommend. So again, when increasing your death benefit, you do pay the agent, but you want to make sure to pay yourself. So for example, with my client, he's paying $20,000 in, but the target premium, which is probably won't mention in this book, but the target premium is what the insurance company is looking at, and the target premium means this is how many dollars per year, which kind of also answers Mister's earlier question. This is how many dollars per year it would cost just for the pure death benefit. So for example, I think it might be $10,000 a year at his age that would buy him an $850,000 whole life insurance policy. However, the agent now gets paid off of half of $10,000, as opposed to if they're just increasing your death benefit and not structuring the policy properly. That same scenario, they're going to get paid off of they're going to get paid half of $20,000. So they're going to get $10,000 as opposed to $2,500 because they get paid half of $5,000. Right? So increasing your death benefit doesn't necessarily mean you've uh, supercharged your policy, which they'll get into that here shortly as well. So where was I? So once we get started, can we start using the money right away? Or do we have to wait? Jason asks. Well, it will depend on how we structure and fund the policy. Remember, your premium payments are used to pay the cost of insurance, and anything above those costs is allocated to an index account. You will have policy fees and expenses that you will need to consider as well. Optimally, it's best for you to wait and allow the policy to accumulate some cash value and gain some interest, kind of like equity in your home, guys. It's literally the same concept. The risk with borrowing too soon from your policy is your loan will most likely be a fixed loan and not participate in the index. I mentioned that previously. The best thing to do is let's talk about I mentioned that previously. The best thing to do is let's talk about how much you want to put in the IUL, how much your remodeling project is going to cost, and then let's run some numbers and see when it will be the earliest time you can access your cash value for this project. Once you're approved for the IUL and you're ready to access your cash value, usually you can access your cash value within a couple of weeks. Also, as I mentioned earlier, you'll want to pay back your loan. So you'll be able to fund future projects and supplement future financial needs. It is important to realize that an IUL is not a get-rich-quick scheme, emphasizes Michael. It's a long-term approach to put you on the path to becoming wealthy outside of Wall Street. It requires diligence and patience. You keep talking about becoming a millionaire. If using your approach, we're able to cut back on some of these areas where we're currently wasting money, change my withholdings so I keep more of my tax money throughout the year, and redirect my $550 per month 401k contribution over. That's about $400 a month on taxes, $550 on our 401k, and we're wasting another $50 a month right now on an extra landline phone we don't use. So, how much do we have to put? About $1,000 per month into a policy? Jason asks. Good question. This is the beauty of the IUL. By structuring and funding your policy properly, it allows you to put money away and know with relative certainty how much is going to be there for you when you need it. Susan chimes in, yeah, I'm really tired of opening our 401k statement and seeing it go down, down, down. Usually, an IUL performs best the longer you let it grow and compound. When do you think you want to start taking money out? Michael asks. Well, let's say at age 65, Jason says. After crunching a few numbers, Michael says, assuming that you get an average growth of 7% using this indexing strategy, we'll cover this in a second. At the age of 65, you could have right around $643,000 with a death benefit of approximately $929,000 that could go to your spouse or children. But here's the real exciting part. Are you ready? Yeah, what have you got? Jason says. Using the projections, at age 65, you can have an annual cash flow that you access from your cash value without a taxable event of $86,000 a year until you turn 100. $86,000 a year that I get without a taxable event? Wow, that's amazing, especially considering it's not going to get wiped out in the market downturn, and we know we can count on it being protected, Susan says. $86,000 a year for 35 years is like $3 million. How is that possible? Jason asked. Remember that when you take a variable loan, you borrow against your policy. The cash value continues to grow as if it's never been touched. It's also important to remember these projections are done using the insurance company's actuarial projections. They use data from the past 25 years, but they aren't guaranteed. There's a chance that it could be less than that. Susan jumps in. I appreciate you saying that. I hate to be sold a bill of goods only to be disappointed, even if it's half that amount. Having about $43,000 a year to live on until age 100 is pretty fantastic. Plus, that money isn't at risk in the market. $1,000 might be pushing it for us right now. What would happen if we only did, say, 500 a month? Susan asks. No problem, Michael says. With 500 every month, you're still potentially looking at 43,000. Excuse me. Was it my mother? Hold on. My phone just rang. Okay, no, that wasn't. Okay. No problem, Michael says. With 500 a month, you're still potentially looking at $43,000 every year until age 100. The reason you don't pay tax on this money is because you're taking a loan and borrowing against the policy, not withdrawing the money out of the policy. Of course, this is the way it works under current IRS tax laws. Keep in mind, continues Michael, these policies work with compound interest, meaning the more money you put into your policy, the faster your policy grows. Why wouldn't you want to put as much money as possible into a policy that only gets better the more money you put into it? With traditional financial tools like a 401k or a mutual fund, there's no direct correlation between the amount you contribute and improving results. And IUL gets better as you add more. In fact, the growth maximizes when you need it most during your later years. Interesting. So we should consider finding ways to increase the amount we pay in because we'll get better results that way, Susan asks. Exactly, Michael adds. Plus, don't forget that you can access that money without having to pay taxes on it under current IRS tax codes. And as long as you structure and fund the policy correctly, that's why working with an individual agent who understands how the IUL works is so important. If you don't do it right, you could lose major tax benefits or miss out on maximizing your cash value growth. This is too important to trust to someone who hasn't had the proper training. As we step away from the table, it's clear that Jason and Susan are off to a good start on their journey to becoming wealthy outside of Wall Street. But as we leave them to the beginning of their new financial life, we have some shocking revelations to show you. In the next chapter, we'll show you what might just be the most exciting part of this whole process. Part of the reason why Jason and Susan could potentially have such great cash flow in retirement is because the premium payments are used to pay the cost of insurance, and anything above the cost is allocated to an indexed account that receives interest credits based on the performance of the underlying index with an IUL. This allows them to benefit when the market goes up, but never risk their money to loss when it comes down. That's exactly what you'll see in the next chapter. How to fund, how to find money to fund an IUL. I'll have that back, thank you. How much is your tax refund each year? Think about changing your deductions to keep more, I'm going to give you that breakdown. So one, I'll have that back, thank you. How much is your tax refund each year? Think about changing your deductions to keep more of your income instead of letting the IRS use it for a full year before giving it back to you. Two, redirect your cash flow. Often, you can redirect money currently going into market investments into an IUL. Three, make your money go to work for you. Often, funding a policy with excess money you've got in the bank makes sense as an alternative solution for having your money work for you. Four, protect against volatility. This may be a no-brainer. If you have money in stocks or mutual funds, consider moving some money out of the market if you are tired of market volatility. Five, stop the expenses. When they add it all up, people are often shocked at how much extra they are paying in insurance, utilities, and other everyday expenses. Making some minor lifestyle changes or just doing a little research on reducing current expenses can help you build up your cash value and get on the path of the wealthy. Six, enforce insurance policies. Many people have existing life insurance policies that are not structured as effectively as possible. You may be able to do a 1035 exchange that keeps the cash value and the tax benefits you currently have while improving your results. So, guys, you've heard me talk about 1035s all the time. I also talk about it with selling real estate instead of doing a 1031 exchange. But literally, you can do a 1035. So you take the cash value that you've built out of one existing life insurance policy and you roll it over into an IUL. That'll actually help speed up your cash value accumulation. I call it beat up the cash value. Seven, chopping away at debt. Instead of slowly chopping away at debt, consider funding an IUL and then taking a chunk of money and paying off the balance of a credit card. This could save you a substantial amount of interest costs. Eight, splurge on your future. Instead of taking the money from your tax return and buying that big screen TV or trip, consider funding an IUL and building on your financial future. Nine, mortgage payments. If you're currently making extra payments to your mortgage principal, consider putting that cash into an IUL, which giving you access to that cash without having to qualify for a loan in order to use it. So, ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So we're on chapter 10. There's 3 more chapters left in the book, but like I said, my mother's on the way. So I'm going to pause here and I'm going to go for probably go sit with my mother for a couple minutes. And I know she's got to go. She's basically just going to run, pick up the macaroni and go do what she got to do. And then I'll come back and I'll continue a little bit later today. And we'll pick up from the beginning of chapter 10. She says, could you repeat the one about the mortgage? So, number 9. If you are currently making extra payments to your mortgage principal, consider putting that into an IUL, which will give you access to that cash without having to qualify for a loan in order to use it. All right, so I'm gonna go ahead and pause here. But when we come back, all right, that's a funny chapter. So, chapter 10 is titled "Supercharging the IUL." And I'll read you guys a quote from the beginning of the chapter. It says, the first rule of investing is never lose money. The second rule is never forget rule number 1. A quote from the illustrious Warren Buffett. I almost don't want to stop. I want to just keep going. You know what? I might just keep going and bring y'all with me. And then when my mother comes, I'll bring y'all with me, and then y'all can just go on a journey with me. How about that? Fuck it. Well, yeah. So, ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. So, chapter 10, supercharging the IUL. I've always wanted to fly, not in a plane, hot air balloon, or with the help of something man made. I simply wanted to look up and take off flying through the air. Unfortunately, I haven't figured out how to make that happen. Like the old saying goes, what goes up must come down. I learned that the hard way jumping off the bunk bed as a kid. As we've discussed, this up and down phenomenon is not limited to physics. It happens quite frequently in the stock market as well. We can have some exhilarating rides up only to suffer financial broken bones when the market comes crashing back down. But it doesn't have to be that way. In this chapter, I'm going to show you how you may just be able to defy market gravity. One of the most exciting things about an IUL is that you can supercharge the cash value portion of your insurance policy. The policy builds cash value based on premium payments that are above the cost of insurance. So yeah, now he's talking about overfunding an IUL. The policy builds cash value based on premium payments that are above the cost of insurance and other expenses and the performance of the underlying index. One of the benefits of using an IUL is it is tied to changes in an indexed account, which can allow you to enjoy the upside growth of the market while enjoying the protection from negative returns. You can go up without coming down. In other words, the index account in an IUL typically has a floor and a cap. Sometimes you could reach the cap, which could give you double-digit returns in some years when the market has gains. Likewise, even though you will still have policy fees and expenses, you will not receive a negative credit when the market has downturns. This means when the market goes up, your money can grow. I'll explain this more in a second. But when the market goes down, you are protected and your money cannot receive a negative credit because of a market downturn, but you will still have the policy fees and expenses. This can be extremely beneficial during times of market turbulence and years when the market goes up. So do your cash values. And when the market falls, this is where the floor comes in and you receive a zero crediting and you are protected against that loss. Your money is locked in so you don't lose. You will have to pay the policy fees and expenses though. So basically, The market goes up, your money goes up. The market goes down, your money stays at zero. Hold on, I think my mother's at the door. Hey. Okay, never mind. She's not at the door. So where was I at? Um. So yeah. Basically, long and short, when the market goes up, your money goes up. If the market comes crashing down, you don't lose any money. You still may have any fees that are associated with your policy, which is mainly the cost of insurance. Now, why is this so important? It is important because inflation is one of the biggest threats to growing your money and wealth. If inflation is running at 3 to 5% or even higher, depending on the government's monetary policy, it's important to have your money outpace inflation. If your money is growing slower than the rate of inflation, you aren't growing your money. You're actually decreasing the value of it over time value of money. The IUL can allow you to outpace inflation by capitalizing on potential growth in the years when the market goes up. Wait a minute. Didn't I just spend several of the first chapters in this book explaining why the stock market may not be the greatest place to invest your money? Am I changing my tune? Not at all. The cash value of the cash value growth in your index universal life insurance policy is linked to the S&P 500, but your cash is not actually invested in the market. So literally life insurance, ladies and gentlemen, is a hedge fund. Basically what he's going to tell you here is here's how cash value is built in life insurance. They invest heavily in the bond market, right? That's how they're able to guarantee you in traditional whole life that's the whole big thing about Rule 7702 or IRC 7702. But anyway, they invest in the bond market and then they take those returns and they uh, spread some of that profit over to your cash value. What's this question? Uh, Well, something similar. You have to get registered, and there's a lot of stuff you got to go through to have a fund registered. Um, but that's not exactly true. It just depends on the type of fund that you're looking to have. Um, if it's completely private, there's not too many. But then it's blocked to accredited investors only, right? Um, But like I said, life insurance is literally a hedge fund. Why? Because they invest heavily in the bond market, and that's how they create your cash value with whole life or permanent life insurance. Well, with IULs, not only do they take that money because of your premiums, things like the cost of insurance or the fees, they then take that and they invest in the bond market. Not the bond market, I'm sorry. They invest in options, stock options. Now, when the options accrete or go up, they are able to take some of those profits, and that's where you get like your crediting or your interest crediting based on what they're getting from those markets and those stock options. If the stock option should go down or fail, they simply let it expire, and the only money they've lost, the insurance company, is the premium that they've paid, which doesn't touch any of your money, but the premium that the insurance company paid to purchase the stock option. Now, again, I don't talk that investment shit, but I sure know about it because you have to know about it in order to do these IULs. I happen to know that it's better to let the big corporations trade the stock options instead of trying to make a play yourself. Because you can't trade on the level or the scale that these big boys can. But Instead of trading the options, I know what you're doing is you're looking for a hit of dopamine. You might as well be that heroin fiend on the corner. This is what these corporations do for a living. So at any rate, where was I? So if your money is growing slower than the rate of inflation, you aren't growing your money. You are actually decreasing the value of it over time. The IUL can allow you to outpace inflation by capitalizing on potential growth in the years when the market goes up. Wait a minute. Didn't I just spend several of the first chapters in this book explaining why the stock market may not be the greatest place to invest your money? Am I changing my tune? Not at all. The cash value growth in your index universal life insurance policy is linked to the S&P 500, but your cash is not actually invested in the market. Remember in chapter 2 when we showed you the different plunges in the market, when we showed you the different plunges the market had taken over the years and how long it took to recover and return to even? Now, you don't have to deal with that at all. Your money is protected from any market loss because it's not directly in the market. But at the same time, you benefit from the growth of the S&P 500 up to a limit or a cap. Let's say the upside cap is 12%. This can vary from policy to policy and carrier to carrier and year to year, by the way. This means even if the market goes up 14% or more, your cash value growth would be limited to just 12%. Having a cap is actually a good thing because this is what allows the insurance company to protect you against losses in those years when the market goes down. Let's look at a picture that will illustrate this point. This is a hypothetical example of a stock market strategy versus an index strategy. I show you guys this all the time when I show illustrations on my computer screen, so I'm not going to go through that. So we'll skip to the next thing. So, actually, let's read it. Fuck it. Right? You just won't be able to see the pictures. So, So let's say you start out with $10,000, and in the first year, the S&P 500 grows by 10%. The first year, there's no difference, and you have $1,100 in either account. In year 2, your money grows another 10%. So now you have $12,100 in either account. But let's say that in year 3, the S&P drops 20%. Can that happen? Sure it can. The last few years of the 2000s were the worst times in that. Now, you would have about $9,600 if you had invested directly in the S&P 500. However, in the index strategy, your principal and interest are protected against market loss. So now, instead of 9,600, you hold at 12,100. Like I said, when the market goes up, your money goes up. When the market goes down, your money stays flat, right? So in year 4, the market drops another 17%. Now, instead of having 9,600, you have around 8,034. In the index strategy, you still are at 12,100. Now, here's the $1 million question. Do you want 8,034 or 12,100? Well, that's quite a difference. And it's clear from this example that losing principal can be financially devastating. That's why Warren Buffett said it's not so much about the return on your money as the return of your money. When you lose principal, you've got to get big time results to bring it back to even. What is the best insurance company for homeowners insurance? That varies. There's really, when you're looking at property and casualty insurance, there is no best. They're like McDonald's and Burger King. They pretty much offer all the same shit because it's stuff insurance, right? There are some variables. Certain carriers won't protect certain things. It also depends on the region of the world that you're in because some companies aren't in certain areas of the world or country, I should say, right? Like I might say MetLife, but MetLife might not be in your section of the country, right? So that's a difficult question to answer. So here we go. Now, let's look at what happens when the market rebounds. Let's say in year 5, the market grows by 15%. In the stock market strategy, the 8,034 would get the full 15% growth, which is about $1,205. So your cash value would climb back up to a little over $9,239. In the index strategy, your money would only grow by 12%. Remember, we have a cap to 13,552. But even with the capped growth, you have $13,552 versus $9,239. Again, quite a difference. I want some of that action. I want my money to grow and not lose principal. Holla at me, bro. Let's get you an IUL. But again, we're not just gonna go and get an IUL. Let's have a consult to see what the best strategy may be for you. And then we shall go from there. In this example, the downsides of the stock market strategy were after 5 years, you end up with less money than you started with. It will take a 25% return to get you back to your original 10,000. And how likely is that to happen in 1 year? Even if you did get the 25% you will need, it will only bring you back to the 10,000 you started with. You just lost 5 years and you're just barely back to even in that $10,000 investment. Can you see why the indexing strategy is so exciting? Now you can have your money growing when the market goes up. You could outpace inflation with potential double-digit gains, and you never have to worry about losing money when the market goes down. Thank you, Malika. What kind of peace of mind would that give you, knowing that your money is protected from market volatility? Now, what would happen if the market goes down for 10 years in a row? Many of the IUL policies can be set up so that there's a fixed interest amount of growth credited to your policy cash values, which guarantees that even if you don't achieve growth in the index, your cash value can continue to grow. Every policy is a little bit different. That's why it's so important to work with a professional who can show you your options. The rest of the IUL benefits still work the same, meaning you can finance yourself to wealth by accessing your cash value for cars, college, or cocaine. No, I'm just kidding. uh, by accessing your cash value for cars, college, or other major purchases. Some financial products can even guarantee an income you will never outlive. Hold on, guys. That's my mother. Sure. Fuck it. I'll try to bring y'all with me. I don't know if I might lose signal because, uh, well, I'm not on Wi-Fi, but I am getting in an elevator and all that good stuff. So, you know, that, uh, that happens. Financial power in the USA is banks and insurance firms. It's definitely insurance companies are banks. Yet guaranteed income that will never outlive. I want some of that. I'm gonna let my mama know. You said hi. In fact, I might surprise her and make her say hi to y'all upon the line with me. Let's see. And then I'll bring it back up. And we can get back to it. Now, it's funny also that you asked the question, Broke Genius, what's the best insurance company? Because right now I'm wearing my State Farm shirt. So you might think I'd say State Farm, but then I could be wearing my Allstate shirt. And I could be dealing with farmers because I have an agent with me who has her farmers agency. Um, but then again, like I said, regionally it varies because you have you know things such as, for example, there's certain carriers that are. It's a. Listen, I'll even bring you some of the green beans and the turkey breast. That's how. Listen, you'll definitely you do this IUL strategy, you'll have more than enough.
First floor lobby.
Let's see. Uh, oh, it's raining out. Dagnabbit. Mm. It's coming down too. Yes, y'all. So, ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So, yeah, ladies and gentlemen, when I get back to the book, again, he's definitely talking about supercharging the IUO, which is likely overfunding it, which is, again, a concept that I talk about. But again, the reason why he's saying you have to talk to a professional who knows what they're doing is because these are they make big commissions off of these type of policies because once you hear all the benefits of it, it does make sense to overfund it and pour more money into it. And you want to make sure that you're what up, Brody? Chilling. So you want to make sure that while overfunding it, you're not just uh, putting bread or putting money into the policy. You want to actually make sure that it is in your financial interest. And one who knows what they're doing may or also not recommend that policy for you. They're not only going to have a grasp of the IUL, but they're going to have a grasp of uh, other multitudes of policies that and how they work, right? So you're gonna understand, you know. Hold on. Nice cheese. All right. Well, later. Enjoy it. Call me. Tell me how you liked it. Give Grandma a hug and kiss for me. Yeah, I figured she was just gonna come by, pick up her stuff, and get going. Actually, while I'm down here, let me check my mail. It is 4 o'clock. But yeah. I actually, hopefully, will be able to do this for her son because, ironically enough, she has her policy with another carrier that didn't set it up right for her. But even things like that, uh, and the agent who, like he mentioned, one of the options you can use is a 1035. So cancel your current policy and put it into an IUL, right? That sounds nice in theory, However, in practice, Marcus, what's going on, brother? Salute. Prime example, my mother has a whole life policy with another carrier that set it up as a whole life policy, and she was under the impression that she would have um, something set up like this, and she does not. Now, once I reviewed the policy, I explained to her it may be in its benefit to cancel the policy and roll it over. But at this point, she's been paying into the policy for a certain period of time. If it's like the first month or inside of the first year, um, I don't mind having you face what's called surrender fees. But again, an advisor who knows what they're doing, a qualified financial professional, is also going to know that it's not in your best benefit to have what's called surrender fees. So surrender fees are attached to any whole life insurance policy, meaning that when you cancel it, you do get whatever cash value is built up in the policy back. However, generally in like the first almost 5 years, there is surrender fees, meaning that when you can, if you were to cancel the policy, they charge you money for not keeping the policy with them for a certain period of time. Again, usually inside of the first 5 years of a policy, and when that happens, they also so it costs you money. So a financial professional can't just set you up and say cancel it and then have you face fees, right? So my mother's in that predicament. So what I'm telling her is, hey, the policy you have now, you've had it for a certain period of time. It doesn't make sense for you to cancel it now because there would be no cash value to roll over. So I'm not going to put you in a position where you lose money. So keep the cash value policy for a few more years. And then when there is some cash built up, we'll roll over whatever cash is built up into a policy like this. Now, it's going to be difficult because of her age. And, that's one of them things, I guess, we just got to deal with as a folk, right? Is sometimes you may age yourself out from being able to afford uh, these concepts. And it is what it is. So where was I? I was in this here book, and I might keep this short today because my phone is dying, and I'm actually a little hungry myself now that I brought my mother that mac and cheese. I want to finish me some too. Now, would happen if the market goes down 10 years in a row? Many IUL policies can be set up so there's a fixed interest amount of growth credited to your policy cash values. Oh, yeah, so we were at the never outlive your income. Well, we'll finish reading this. So, many of the IUL policies can be set up so that there is a fixed interest amount of growth credited to your policy cash values, which guarantees that even if you don't achieve growth in the index, your cash value can continue to grow. Every policy is a little bit different. That's why it's so important to work with a professional who can show you your options. The rest of the IUL benefits still work the same, meaning you can finance yourself to wealth by accessing your cash value for cars, college, or other major purchases. Some financial products can even guarantee an income you will never outlive. Now, with all that being said, index life insurance doesn't have to be where you put all your money. But for many people, it is an excellent way to position a portion of your portfolio to enjoy the ups of the market without the downside risk. This is obviously a brief introduction to the indexing strategy. To learn more about how this works, just request a consult with me either when I'm done here or later on today. Or if you're reading this back at the time that you're watching this replay. So, the wrap. The Index strategy makes sense for people who want to avoid market risk but still want the possibility of double digit gains and all the other benefits that the IUL can give them. Using this strategy, you could save more money even without changing your current lifestyle by repositioning some of your assets from being deposited into accounts that are taxed during retirement to an index life insurance policy. The supercharged indexing strategy could allow you to benefit from double digit gains in up years, help outpace inflation, grow your money tax deferred, access cash values without incurring tax, and provide cash flow for life. To maximize your growth and give you all of the advantages described here, an IUL should be from an life insurance company that meets these following requirements. One, cash max structure to maximize cash value and minimize insurance costs. Two, 2% guaranteed growth on the cash values. Three. So yeah, let me talk to that 2% guaranteed growth. So this is where again people like Dr. Jake Jacobs and Chris Kilpatrick of Life 180 try to get over because they're like, well, you get higher. What about the guarantees with traditional whole life? The guarantees is that you're gonna pour more money into the policy and they're gonna get a higher fucking commission. That's all it is. But again, I'm going to get a higher commission because when I show you how the IUL works, you're going to put more money into that than you would in a traditional whole life, right? So the guarantees with a traditional whole life are 3%. The guarantees with a good IUL company are 2%. Life insurance is a monthly compound interest game, Mister. That's why it outperforms the IUL outperforms the S&P, right? There are people who are getting between 20 and way more percent. There's a guy by the name of Doug Andrew who promotes the IUL. He calls it the laser fund, and he's had clients who have gotten nearly 60% growth annually because of the monthly compound interest rate. Oh yeah, it's not just the monthly rate, it's monthly compound. I've not heard of that guy, Broke Genius. So yeah, you'll definitely want to you'll hear again Dr. Jake Jacobs of the Private Banking Society, and shout out, I still watch him. I just disagree on traditional whole life. And there's reasons why they think traditional whole life. Right. And then they'll be like, well, hey, even ginormous companies stopped selling the IUL and told you to stop doing infinite banking. Yeah, they did, but that's because a lot of people don't know how they work, and it's more beneficial for And then they're like, "Oh, it's because they're more beneficial." Okay. Yeah, Doug Andrews has the laser. He calls it the laser fund. I call it the opportunity fund. It's an overfunded IUL, long and short. But again, there's few, and everybody else in the industry is trying to refute the IUL guys. Oh no, don't listen to my IUL guys. They talk bullshit. Term or traditional whole life and everything else goes in investment. Don't do the IUL. No, 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 no. The IUL benefits the insurance company more. Nah, not really. Yeah, it's easy to be honest, Broke Genius. Insurance is really easy to become a millionaire, and especially if you do it boiler room style and you just pound the phones, right? He's probably selling a bunch of final expense and mortgage protection. He's not doing concepts like this. Now, it's easy to become a millionaire in concepts like this, too, but you're likely not going to be flashy and shit. You'll actually be invited to the yacht parties and shit because, you're not. Now, I don't know the guy, so I don't know if he's flashy or not. I'm saying he's not invited, but if he has a boiler room style insurance firm, uh, he's probably with like WFG or uh, one of these companies that sells mortgage. He's selling a lot of mortgage protection and final expense. So those are the guys who call you up. Hey, broke genius, how much your mortgage? Half a million? All right, let's get you a half a million 30-year term. And they call, 200 people a day. Guess what? If you call 200 people a day, you're gonna, oh, he's a typical IG guy with a Bentley and more. Okay, yeah. I think, is that one of the guys with Patrick Bet David of PHP, which is a mortgage protection pushing company? At any rate, so, uh, one, you want cash max structure to maximize cash value and minimize insurance costs. Two, you want 2% guaranteed growth on cash values. Three, flexible loans so you can switch from variable to fixed loan and back. Four, participating loans so your money participates in the growth of the index even when you have the loan on the policy. And real quick, oh, that is the Patrick Beck David guy. He said, if I was a millionaire, I'd start shopping at Target instead of Walmart. Hey, I like, well, actually, I like both, right? Me and my wife love going to Walmart, but then we also love Target. We liked Target in Brooklyn more when we were in New York. We didn't really go to Walmart because there weren't really Walmarts in New York City. So we go to like Jersey and go to Walmart. But going to Walmart for a New Yorker is a treat because there's almost no Walmarts. Um, she says, and Whole Foods. But yeah, another thing about a financial professional, like I listen to all of these guys' concepts because it's like what is it, like Bruce Lee with Jeet Kune Do, right? And so sometimes they do have effective ways of explaining things or getting it across to the public. Tarjay, yes. She says Whole Food is Whole Food. Well, what about Trader Joe's, Mister? 'Cause I go to both Whole Foods and Trader Joe's. I prefer Trader Joe's for most of my things, but Whole Foods is cool. But yes, Tarjay broke genius. So participating loans, so your money participates in the growth of the index, even when you have a loan on the policy. Five, loyalty bonus on cash values at year 10. Six, decreasing or disappearing charges. Seven, very strong financially, confirmed by independent rating services. Eight, cap that allows double-digit growth in good years. And nine, a 100% participation rate so your cash value grows dollar for dollar when the index grows up to the cap rate. So, chapter 11 is more wealth beyond Wall Street strategies. All truths are easy to understand once they are discovered. The point is to discover them. A quote by Galileo. So I'm not going to go through this chapter. I'm going to pause here because I've been going for almost 2 hours, an hour and 45 minutes. I'm trying to keep these to less than 3 hours. Um, so, ladies and gentlemen, if you enjoyed the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware anytime I release new content. Actually, I do want to read these last 3 chapters to y'all today, so I'll probably come back because I did want to do Monetary Monday, even though I did Midday Monetary Monday. But make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to continue to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. Now, with the Indian food, white bass definitely makes sense, don't it? uh, with that being said, ladies and gentlemen, wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. Oh, shit. Wow, sorry. I guess the phone is a little testy today. At any rate, ladies and gentlemen, if you enjoyed the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. With that being said, wipe ass, work in progress every day and see success. Wipe ass, work in progress every day and see success. Wipe ass, work in progress every day and see success. And remember, ladies and gentlemen, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.